margins have come under intense pressure, but we can assure you that this has less to do with their competitive positions. For Amazon, Alphabet, and Microsoft, we believe 2023 is the year to blow up faster, and in our video today, we give you reasons why you should be still bullish on these tech stocks. Let's first begin with Amazon. Amazon is down 50%, and while that is terrible, to say the least, it is important to note that this is still the same company that prior to the pandemic had profits inflecting upwards. In the first 9 months of 2022, the e-commerce giant was affected by rising fuel prices that subsequently affected delivery costs and the costs to run its cloud data centers.
Everyone is so downbeat after that forecast, tough talk on the macro economy, slowdown in cloud growth.
Every year, and for its Amazon Web Services, it does break out on its operating margin, which is usually in the high 20% to low 30% range. The reason why we remain extremely bullish on AMZN is first that the US dollar index has meaningfully declined over the past few months. CEO Andy Jassy is also rationalizing Amazon's logistics footprint and announced over 18,000 planned layoffs. To address some of the excess hires made over the past 2 years, Amazon is taking steps to cut non-core projects, and we definitely believe earnings could surprise the upside through the year. Given that AWS margins are around 30%, it is likely that Google Cloud Services will eventually be profitable. How? Let's give you the details in a bit. Remember that the content of this video is for informational purposes only. Diligently do your research before investing. Microsoft fell nearly 30% in 2022, as it was also hammered by the strong dollar and macroeconomic issues. Still, it is the most profitable of the three due to its monopolistic business and side ventures, including Windows, Office Dynamics, Azure, LinkedIn, Xbox, and many others. Recent plans to incorporate ChatGPT into its Bing search and attempts to buy Activision Blizzard shows that the tech company is making bold attempts to expand even further. The company already operates on a large scale, and with MSFT's sharp decline last year, stocks are more attractive to buyers. 2023 looks to be a good year for Microsoft and investors once it attempts to begin to generate more earnings and revenue for the company. Certainly promises to be a great year for tech stock.
Good news!
With friends and loved ones interested in the happenings of the stock market this year. After its 2022 downdraft, Alphabet is now the cheapest of the three, trading at just 17 times earnings. Depressed profits, cloud division losses, and significant declines in other segments have made its core advertising business across Google Search, YouTube ad networks, and Android even cheaper. But Alphabet also has a lot of net cash on its balance sheet and still has a dominant position in search and YouTube. It is also hard to believe that amidst cloud losses, Alphabet's cloud division holds no value. The company was undoubtedly most affected by the strong dollar, and with that reversing recently, the advertising segment should be back on its feet pretty soon. All three tech stocks have one thing in common, and this is the major propellant for high growth and significant earnings. In a bit, we'll tell you all about this. A lot of growth tech stocks have never actually earned a profit. These three tech stocks have, however, demonstrated big profitability in their core businesses before. This means that even if rates stay high, these tech giants could fare better than unprofitable growth stocks that need ultra-low rates to fund their growth. We'll bring you all the updates as and when these stocks begin to gain profitability in the market, so make sure to subscribe to this channel. The common link between Alphabet, Amazon, and Microsoft is that they are a part of the cloud infrastructure oligopoly. These tech stocks have the best chance to rebound even if the current slowdown persists. Research company Gartner projected in October that cloud infrastructure growth will move from 27.3% this year to 29.8% next year, whilst Allied Market Research believes the cloud infrastructure market will grow an average of 25.3% annually between 2021 and 2030. These three cloud infrastructure leaders are each well-positioned for the year, and with sharp price declines, they are now even more affordable. These stocks are growth investors' best bets in 2023. For more details, check out our video on why we think AWS will skyrocket again and boost Amazon stock to new heights. Thanks for watching this video. We'll come your way again another time.